So, Larry, can the Fed do anything about this?
Well, that's not the main thing that's going to help here. We don't know at this point the severity or the spread of the crisis, and that's what's really going to cause markets to bounce, not the Fed. Fed probably helps, especially with getting the dollar down. We've already seen a massive rally in bond yields. So if anything, a Fed cut, which I think is likely in the next couple of weeks, if we're in the same situation when they meet next. But that's not really going to turn things around. It's really going to just confirm what's happened.
So what do you make, Larry, of the scale of the equity market sell-off we saw last week and this initial bounce today? Do you think the bounce holds?
No. I mean, first of all, we have not seen the economic damage yet, as somebody mentioned before on your show. And it's going to be significant. I mean, it's coming from both the supply side in terms of, supply disruptions from the likes of China, and the demand side. Who's going to go on a cruise today? So it's going to be pretty significant. So what I would say is this for the average investor: don't panic. Investors tend to sell after things plunge and go down, and then buy after they rebound and go high. So they end up, selling low and buying high. Stay in there, basically, because even though we don't know the severity of this or the spread, it will be contained at some point. The economy will bounce back. You can feel pretty confident that before the end of the year, even if it lasts a long time, like 6 months, stock prices are going to be higher than they are now, and so are bond yields. So stick with it, is what I would say, and stay calm. Again, we haven't seen the damage yet. I don't know. You've been saying the rally today is because of Fed expectations. I think that's been there for a while. We had a very severe drop last week of some stocks that people like are now pretty attractively valued. And I think you're probably seeing some people edge in a little bit here. But if it were me, I'd probably expect more declines going forward.
But you tell people not to panic, Larry. And I guess,
Right.
the idea is you have to think about the time frame here. With that in mind,
Right.
What are you looking at? Because I was speaking with someone who, is going to be retiring soon and says, I can't go through another financial crisis like we had because I'm so close to retirement. So what do you tell someone like that?
Well, if you're a year or two from retirement, you shouldn't have been overloaded in stocks in the first place. Stocks, as you know, we have corrections. We had a very long period where things were just going up. We're probably going to get a correction anyway, not this severe. But I would still say hold steady because things will improve. Again, we don't know how long this is going to take, but it would be shocking if this isn't contained, say, before year end. I mean, that's I would say the longest that time horizon you'd be thinking about. So, again, my view is stick with what you've got. If you have excess cash, you might want to start looking at least edging into some stocks that look very attractively valued, but be prepared for further declines. That's what I would say. Now, what should we be looking for is the question?
Larry, as for stocks that might be attractively valued, I wanted to ask you about U.S. banks, of course, a sector you know a huge amount about.
Yeah.
They fell into bear market territory, down 20% from their January highs. Does that make sense to you, given the move we've seen in yields, or are those very attractively valued?
I think that's one of the sectors you could think about edging into. But again, any amount of money you put in there, be prepared that things could even get worse because we still haven't seen the economic damage. But in terms of asking the question, what should you look for? Markets will rebound before the economy does. And what the markets are going to be looking for is a peak in the growth in the spread. Okay? So some indication, light at the end of the tunnel, that they're getting this thing under control. When you start seeing a sign, and by the way, there are signs already within China, although they took draconian measures to prevent the spread, that the incidence is slowing. We are not at that stage in the United States and most other countries yet, where actually the spread is accelerating. So that's what you want to look for when to see the markets bounce, and we are not there yet.